Thank you very much for coming. My name is Darren Joseph, HEJ.tax. Our team is really about tax. We work with private clients and we help them demystify the sometimes confusing world of international taxation. We're part of a wider practice here in Asia called Moore's Roland. I'm actually here for Weber Partners meeting. We have it twice a year, and this time it's Jakarta's turn to host us. So I thought while I'm in town, I will set up some time and meet some of you guys. So thanks for coming out. The UAE is quite interesting. I spent time there. I'm also a resident. We have a small office there. It was positioning itself, I mean, Dubai. People forget, again, the UAE is like 7 Emirates, and they're quite different personalities. So, like Sharjah is like the complete opposite of Dubai. And the real powerhouse, even though Dubai is the loudest, the strongest is Abu Dhabi, which is capital, right? They were positioning themselves as low tax or no tax, but there is an international movement at the OECD level. So this is a Organization for Economic Cooperation and Development. Basically, they're a group of rich countries. They've all come together and they've agreed we don't like the idea of companies and people not being taxed anywhere. So you must pay tax somewhere. In addition to which, they've set out certain pillars that say, well, we actually want a global minimum tax. But let's put the global minimum tax to one side. At least you should be paying taxes somewhere. So they put pressure on the UAE, which has historically been a zero tax jurisdiction. And they put pressure in the form of, well, we could put you back on this certain blacklist or gray list and make it hard for you to be part of the international financial community. So as a result, they've implemented a 9% tax. So I mentioned that because if it is that you were attracted or someone was attracted to the UAE because it was zero tax, that's no longer the case. Chances are you'll be trapped because that net is getting wider and wider by that 9%. However, it does offer non-tax benefits. So depending on what industry you're in, particularly trading, shipping, certain other financial services in particular, I guess that's the ecosystem that I'm exposed to. The talent pool can be deeper there than it is in other parts of Southeast Asia. I mean, it is affordable relatively. So we see businesses and people leaving Singapore to go to the Emirates, to go to Dubai. In addition, in terms of their financial legislation, particularly around, for example, about trust, setting up trusts and foundations, the legislative framework in the UAE in certain free zones, because they have a system of free zones, is more developed than, let's say, Singapore. And Singapore's legislation looks dated in comparison. So it offers benefits beyond the fact that it is relatively low tax. Because 9%, it's still lower than 17% in Singapore, 16.5% in Hong Kong. So it's not zero tax, it's low tax, but the infrastructure is attractive. The challenge is the banking, the indigenous Emirati or the Gulf region banks maybe aren't the best, and they're notoriously difficult to work with. But if you can get around those downsides, it can be an attractive jurisdiction. So I think it has a lot of potential. From that point of view, it doesn't have a tax treaty with the US like Indonesia does. So Indonesia is unique in that regard. Singapore doesn't have a tax treaty with the US, even though they have quite a close relationship. So to your point, it means that if someone is a US taxpayer and is earning money in the Emirates, they will have to be paying a top-up tax to the US, both from the perspective of the companies that they may set up and run, but also from their personal income. Because from their personal income, they will be paying no tax because the 9% at this point in time is corporate. In some circumstances, it may apply to individuals, but generally speaking, that 9% is corporate. So their personal income, they will benefit from something under Section 911, the foreign earned income exclusion, which means, let's say, the first 150,000 US dollars or so will be reportable to the US, but not taxed. But everything above that, and if someone is a high net worth individual, that 150 is that's not much. So the rest of your income, even though the Emiratis don't want to tax it, the US is going to tax it full on.